Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. Looking at the global financial scene right now, it feels less like one smooth road and, well, more like trying to navigate two totally different, really bumpy terrains at the same time.
That's a good way to put it.
Over in Europe, you've got this internal political mess clashing with some pretty powerful external trade forces.
Right.
And then you jump over to the U.S., and it's like a handful of giant tech stocks are doing all the work, making the overall market look maybe a bit deceptive.
Absolutely. And recent analysis really backs that up, trying to rely on the old playbooks, assuming Europe's just going to have a standard cyclical recovery or betting blindly that the U.S. market will just rotate like it always has. Well, that looks riskier now than it has in quite a while.
Okay, so our goal today is to try and cut through some of that confusion. We want to give you some clear, actionable strategies, really drawn from what the latest data is telling us.
Exactly. We'll start by unpacking that strange tug of war in Europe, where these internal problems are bumping up against a potentially helpful external factor.
And then we'll shift to the U.S. market. We need to look at why this intense focus on just a few stocks, this polarization, really demands a whole new approach from investors.
Sounds good. Let's dive into Europe first. So that hope for a general cyclical recovery, the kind analysts were getting pretty excited about back in early October,
Yeah.
well, that's cooled off dramatically. The market basically went from feeling optimistic straight into a kind of deep freeze because these internal pressures just kept building.
Okay, let's break those down. What were those internal pressures? I guess the first big hit came from the core, right? Germany.
Yes, precisely. Analysts were really hoping to see that German Purchasing Managers Index, the PMI, the thing that measures manufacturing health.
They wanted to see it keep bouncing back.
Exactly. And the initial trend was improving, which is what fed that optimism. But the latest provisional numbers, they just reversed completely, fell right back into deep contraction territory.
And deep contraction. Just to clarify for everyone, that means things are shrinking, not just slowing down.
Oh, yeah. It's significant. We're not just talking slower orders. We're likely talking about companies cutting investments, maybe even looking at layoffs. So that data point really shocked the market. It basically put out the fire on hopes for a solid, broad recovery actually taking hold.
Wow. Okay. And if a German slowdown wasn't enough, then France delivered what some reports are calling a political nuclear bomb.
Yeah, that's strong language, but you can see why they used it. President Macron calling that snap election after October 26th. It came totally out of left field, a real black swan event.
And that instantly means
Political paralysis,
Right.
in the Eurozone's second largest economy. And you saw the impact immediately. Risks shot up in those key sectors tied to the domestic economy, especially French banks.
So you've got this double whammy. German economy looking shaky, French politics suddenly unstable. Did investors react quickly? Can we see that in money flows?
Oh, definitely. The data from EPFR and Bank of America shows a really clear U-turn. U.S. investors had actually been putting money into European stocks for 3 weeks straight. Net inflows. They were betting on that recovery.
Okay.
But then, boom, third week of October, it flips completely, net outflows. And analysts directly tie that to the French political risk and those German slowdown worries.
This just gets more complicated, doesn't it? What about the euro itself and the European Central Bank?
Well, the ECB meeting definitely signaled deep concern, about the German manufacturing weakness and all that uncertainty in France. And that worry, interestingly, just fuels expectations for interest rate cuts.
Right, but how does that affect the euro? Because usually a weak currency helps exporters.
Right. That's the fascinating twist here. Historically, yes, the big fear was a strong euro hurting profits for exporters. But now, the weak euro we're seeing is actually being read by the market as it's a sign of illness.
So it's not seen as a competitive advantage, but more like a symptom of underlying problems.
Exactly. It reflects this deep economic vulnerability. The currency isn't weak just because rates might be low. It's weak because the economy's struggling. And that encourages the ECB to maybe cut rates sooner, which could push the currency down even further. It's a bit of a cycle.
Okay, so we've got this perfect storm inside Europe. Political instability, manufacturing contracting sharply, and even the currency weakness is seen as a bad sign.
Yeah.
But then, like you mentioned, an external factor arrived, right at the end of October.
Yes, right on October 31st. News broke about a one-year trade ceasefire agreed by the U.S. and China during that APEC summit.
And this is the potential lifeline.
For Europe, this is arguably the single biggest piece of external good news they could have hoped for right now. Global trade friction has been a massive weight, especially on Germany's economy.
Because they export so much.
Precisely. This ceasefire, even if just for a year, brings a huge dose of global stability. And that directly helps Germany's giant global export sectors. Think cars, specialized machinery, complex industrial components, the very sectors that are currently stuck deep in recession.
Okay, so let me get this straight. The European market is being pulled hard in two directions. You've got these strong internal forces dragging it down, politics, the economy, but then you have this really powerful external lift from the trade truce. What does that mean for an investment strategy? How do you even play that kind of tension?
Well, you certainly don't make a simple bet on which way it'll go.
Right.
This clash pretty much guarantees extreme volatility, but maybe without a clear direction. So the core strategy has to shift. It becomes about intense, really precise stock picking. You have to move away from just betting on Europe as a whole, like buying a broad index fund.
So it's about finding companies that are kind of immune to the local drama, big enough to benefit from the global trade truce, but maybe insulated from, say, French politics or a dip in German domestic demand.
Exactly right. The data really suggests avoiding firms that are heavily exposed to purely domestic risks. Think French banks or maybe smaller German companies that only sell within Germany. They're just too vulnerable right now.
So who do you target instead?
You look for the global champions. We're talking about companies that operate on a world stage, maybe have near monopolies or cutting-edge tech. Firms like ASML in semiconductor equipment, maybe Novo Nordisk in pharma, or Airbus in aerospace.
Because their business doesn't really depend on whether France has an election or German factories slow down for a quarter.
Pretty much. They sell globally, they often lead their specific industries, and that insulates them to a large degree from these short-term political storms within the Eurozone.
Okay, and here's something interesting from the analysis. Europe generally has less exposure to the big AI rally compared to the US. Now, that sounds like a negative, but could it actually be a strength in a weird way?
It absolutely could be. It might turn out to be a massive defensive hedge. You're starting to hear more warnings, right, about a potential AI bubble from pretty influential people like Jamie Dimon, Jeff Bezos.
Yeah, those comments got attention.
So if the U.S. market, which is almost entirely running on that AI story right now, hits a wall or has a major correction, well, suddenly Europe's relative lack of AI exposure might look like a safe harbor, a defensive shelter for capital that's looking for stability and growth outside of AI.
That's a perfect segue, actually. Let's pivot to the U.S. market, because it also demands extreme care, but for totally different reasons, all centered around that powerful AI engine.
Right. Looking at the U.S., recent analysis shows that the rally we saw in late October was, well, uniquely dominated, maybe even dangerously dominated by just a tiny handful of big tech stocks.
And this is where the numbers get kind of weird, right?
Yeah.
The S&P 500 index hits record highs, but underneath the surface.
Underneath the surface, you see what analysts call extreme divergence. Even on days the index was up, you consistently had more individual stocks declining than rising within that same index.
So the S&P 500's performance is kind of a mask. It's not reflecting the broader market health.
Exactly. It's like, imagine a couple of Olympic sprinters dragging a huge, heavy sled with hundreds of other runners barely moving on it. Those few Magnificent Seven-type companies, fueled almost entirely by the AI narrative, are doing all the heavy lifting for the index. Meanwhile, the vast majority of companies are lagging or even falling back.
And that single engine, as you said, is AI. It's the massive open AI contracts, NVIDIA's forecasts, Google's quantum computing news. That's where all the money is flocking.
Seems like it exclusively to these few huge AI-linked companies.
Okay, so this huge gap opens up between the leaders and everyone else. And that creates this temptation, right, for investors to think, okay, the little guys have to catch up eventually, the rotation argument.
That's the classic logic, this catch-up or rotation phase. Big tech takes a breather. Money flows into the neglected small-cap stocks, maybe value stocks. The stuff in the Russell 2000 index. It follows historical patterns.
But the analysis we're looking at says, hold on. Why are Wall Street analysts warning that betting on this rotation right now is particularly risky? Isn't rotation normal?
It can be normal, but the argument is that the underlying economic structure is fundamentally different this time. They're talking about a K-shaped economy.
Okay, explain that. Like the letter K.
Exactly. Imagine the letter K, big tech, powered by AI, is that top arm soaring upwards. But the bottom arm, that represents Main Street small businesses. They're dragging downwards or maybe just flatlining. They're suffering.
Why the disconnect?
because those smaller companies, the ones that dominate the Russell 2000, they simply don't have the fundamental strength right now. They're still getting hammered by high interest rates, maybe seeing slower job growth affecting their customers. They're feeling the pain from the Fed's fight against inflation.
While big tech is sitting on mountains of cash and doesn't really rely on debt in the same way.
Precisely. And that leads to the second big warning sign about betting on rotation. For rotation to happen smoothly, you typically need the leaders, big tech in this case, to kind of trade sideways for a bit, consolidate, take a rest.
Give everyone else a chance to catch their breath and catch up.
Right. But what we're seeing now is that these big tech leaders are viewed almost as essential core holdings for big institutions. Their growth stories, especially around AI, are so powerful
That any dip just gets bought instantly.
seems that way. The corrections are short, they're shallow, and the buy-the-dip mentality is really strong. There's no sustained pause. There's no real gap for money to confidently jump over into small caps.
So the running horse analogy comes to mind. You don't jump off a horse that's still running strong.
That's a good way to think about it. So what's the strategy then in this kind of winner-take-all market? The most practical advice seems to be extreme patience. Don't predict the rotation.
Wait for proof.
Exactly. Wait and confirm that a move into small caps is actually happening, that it's a sustained trend lasting several days before you commit serious money to it.
So it takes some courage, maybe, to just sit tight, to endure holding those big AI leaders even when they have a quiet week or two, instead of chasing the laggards out of FOMO, fear of missing out.
That's precisely the recommendation. Having the courage to endure holding your core positions seems wiser right now than succumbing to FOMO on stocks that don't have the same fundamental tailwinds. Selling those leaders now could mean getting off that running horse way too early. Stick with what's demonstrably working.
Okay. But what if an investor really wants or needs some small cap exposure? The sources strongly warn against just buying, say, a Russell 2000 index fund. Why is that so risky?
Because that index, unfortunately, contains a fair number of what are being called zombie companies.
Zombie companies.
Yeah.
Sounds bad.
It is. These are basically firms that aren't generating enough cash from their operations to even cover the interest payments on their debt. And with interest rates still relatively high, these companies are incredibly vulnerable. High risk of default or just massive distress.
So buying the whole index means you're guaranteed to be buying some of these really weak companies along with any potential winners.
Correct. So instead of broad indexing, the strategy, again, circles back to being selective. If you want small cap exposure, look for the hidden gems. Find smaller companies that have a direct, tangible link to the AI boom itself.
How would that work? Like what kind of companies?
Maybe component suppliers providing essential bits for AI hardware, or materials companies whose products are needed for data centers, or maybe small, innovative tech firms that look like obvious M&A targets for the big tech giants looking to acquire new capabilities.
Ah, so you're still tying it back to the dominant AI trend, just further down the supply chain. You're not betting on a general economic recovery for small caps that isn't really happening yet.
Exactly. You're betting on the established winners needing specific things that these smaller targeted companies provide.
Okay, so pulling this all together, whether we're looking at the volatility in Europe or this sharp polarization in the U.S., the big message seems to be caution, extreme selectivity. You just can't rely on the old rules of thumb or broad market bets right now.
That really sums it up. The final takeaway for you, the listener, has to be focus relentlessly on the specifics. Look at individual company fundamentals, check their global reach, and demand proof of resilience or direct exposure to these really powerful confirmed trends, like the stability potentially offered by the APEC truce for exporters, or the undeniable, almost singular force of the AI boom in the U.S.
And thinking back to that point about Europe, we mentioned its lower AI exposure might actually be a defensive hedge. Here's a final thought to leave you with. If that massive U.S. big tech rally eventually does stall or correct significantly, how quickly could global money pivot? Could we see a sudden shift towards those resilient European global champions as investors hunt for stability and non-AI growth?
That's definitely a possibility worth watching very, very closely in the coming months. A fascinating dynamic.
Don't forget to subscribe and hit that like button.